Welcome to the fifth part of the Noble Gold Investments Investing in Gold series. We've discussed the importance of a hedge in your portfolio and why gold is the best asset to fulfill this role. We've also discussed the factors that affect gold prices and the different industrial uses of gold. Now let's talk about inflation. Did you know that if you kept $1 million in cash 20 years ago, it would only be half as powerful today? A little over $570,000 is what it would be worth in today's money. If you invested $1 million in gold 20 years ago, you'd be sitting on $6.6 million in wealth. It's the best way to understand how gold hedges against inflation. Gold freezes the value of your money. Now let's get to the details. As of recording, we've reached a 40-year high, 7.9% in inflation, based on the Consumer Price Index, or the CPI. Our very own Jerome Powell himself already commented that the inflation rate is way too high. Yes, the man responsible for making the decision on how much money to pump into the economy thinks inflation is way too high. It is odd to hear because he knows that the major cause of inflation is the careless printing of money. We keep on pumping dollars into the economy to encourage people to spend without making sure our GDP is rising just as fast. And that is a primary cause of inflation. When we have way too much money, but no product to buy with it. Noble Gold Investments just finished our money series where we extensively discuss the causes of inflation. The link to that video should be on your screen right now. If you want an extensive explanation on the causes of inflation, click that video. The short version of it is this. When the US moved out of the gold standard, it allowed the government to print money without any asset to back it up. Often to get out of the economic distress, we pump money to enable people to spend and gain more confidence in the money and the economy. With more money and no products to go around, prices of goods go up and the value of the money goes down. Gold, on the other hand, cannot be overprinted, overmanufactured, or overproduced. Nothing on this planet can produce gold. It takes literally an astronomical event for gold to form. That is why you can't inflate the value of gold. The world has what it is, and that's it. Unless a meteor containing vast amounts of gold lands on Earth, we won't have any more. Couple this with the increasing demand, not just investment, but also for industrial uses, you will have the exact opposite of what's happening with our currency. Earlier I said if you invested $1 million in gold 20 years ago, you'd be sitting on $6.6 million today. Let's make it more concrete. $10,000 back in 2001 would have afforded you 18 months of rent for a one-bedroom apartment in Los Angeles. This year, $10,000 would only pay 7 months of rent in a one-bedroom apartment, and not really the best part of Los Angeles. But if you invested that $10,000 back in 2001, the value in gold, the value you'd be holding now, you'd be able to pay for 34 months of rent for a one-bedroom apartment in Los Angeles. That's what gold does. That's how gold fights inflation. It freezes the value of your money. Do other assets like stock and crypto appreciate in value over time? Yes, but they play a different role in your portfolio. And you should invest in those too. Now we have a clear idea of the role gold will play in your portfolio, its potential, its uses and factors that affect its price. Let's get into different ways you can invest into gold.